Welcome to Talk Tickers. We're here to break down corporate earnings calls, giving you the insights you need.
Yep.
Today, we're digging into Selective Insurance Group, specifically their first quarter 2025 earnings call.
Right. And what we saw was, well, a pretty solid performance, actually, especially considering the kind of tricky economic backdrop.
Solid. Okay. Let's start with the big numbers then. What stood out?
Well, the combined ratio came in at 96.1%. Now, for you listening, that means for every dollar they took in premiums, about 96 cents went out for claims and expenses.
So, still profitable underwriting overall.
Generally, yes, though that 96.1% did include 3.7 points specifically from catastrophe losses. Bit higher there.
Okay, cat losses. Anything else impacting that number?
Just a small factor, about 0.4 points from some unfavorable reserve development, basically needing to add a bit more to cover past claims in personal auto.
Got it.
Yeah.
And how did that translate into overall profitability, like return on equity?
Pretty strong, actually, 14.4% ROE, and that was consistent whether you look at the GAAP number or their operating ROE.
Okay, 14.4%. That's a healthy return. What about growth? Premiums written.
Net premiums written saw some decent growth. The real drivers were their excess and surplus lines, E&S, and standard commercial lines.
But not everywhere.
No, interestingly, personal lines, net premiums written actually decreased.
Okay. Sometimes that's a strategic choice, right? Pulling back to focus on profit.
Exactly. And that seems linked to their pricing actions. Overall renewal pure pricing, so just the rate change on renewing business, jumped to 10.3%.
Wow, 10.3%. How does that compare?
That's up 2.2 points from last year. And significantly, it's about 3 points higher than what they assume their claims costs or loss trends will be.
So they're actively trying to get ahead of inflation and loss costs. Makes sense. What about the investment side?
Also looked good. $96 million in after-tax net investment income. That's up 12% year over year.
Nice boost. And book value.
Book value per share was up 5% during the quarter, so building shareholder value there too.
And looking ahead, any changes to their guidance for the year?
Nope, they held firm. Still guiding to a full-year GAAP combined ratio between 96% and 97%.
Which implies what for ROE for the full year?
If they hit that, it points towards a mid-teens non-GAAP operating ROE. So management seems pretty confident they can maintain that profitability level.
Okay, let's dive deeper into that underwriting performance then. You mentioned the pricing push. What's the overall goal there?
Yeah, management was clear. The focus is getting back to kind of their historical sweet spot. Consistent underwriting margins, aiming for that average 95% combined ratio and a 12% operating ROE.
And that 10.3% renewal pricing is the main lever for that.
It's a huge part of it. The idea is if you increase rates faster than you expect costs to rise, you should see margins widen out over time, assuming, of course, your loss trend forecast is right.
Right. Always that assumption. How did things look in their different business segments? Standard commercial.
Standard commercial lines came in at a 96.4% combined ratio.
Right.
Pretty solid. Renewal pure pricing there is up 9.1%.
Strong increases. Any specific areas within commercial?
Oh, yeah. General liability saw a big jump, up 12%, and commercial property and commercial auto were both up over 10% as well.
Wow. Were they keeping customers with those kinds of increases?
Retention held steady at 85%, which is pretty good in this environment.
Okay.
And if you strip out workers' comp, that commercial lines price increase was even higher at 10.5%.
Okay. What about excess and surplus, the E&S lines?
E&S was really a highlight. Combined ratio of 92.5%, and the underlying, which strips out cats and prior year development, was even better at 81%.
Very profitable. Did grow.
Big time. Net premiums written up 20%. That came from both price increases. Renewal pure pricing was up 8.7%, and just writing more policies, strong growth.
But are they just chasing growth there? It's a competitive market.
They specifically said they're prioritizing profitability over just pure growth. Disciplined approach, it seems.
Good to hear. Now, personal lines. You said premiums were down, but how was the profitability?
Big improvement there. Combined ratio is 98%. That sounds high, but it's actually 7 points better than last year.
7 points. How they manage that turnaround?
Pricing. Renewal pure price in personal lines was up a massive 24.1%.
24%. Okay, that explains the drop in written premiums then.
Absolutely. They said it was deliberate. They cut back new business by 58% in states where they felt the rates just weren't high enough yet. New Jersey was mentioned specifically.
So shrinking to get profitable. But did any part of personal lines grow?
Yeah, they mentioned that their target business within personal lines actually grew 11%.
Yeah.
So they're being selective, pun intended, about where they want to write business.
Makes sense. Do they expect those huge rate increases to continue?
They expect rates to keep outpacing loss trends, but they did signal that the level of increase will probably moderate compared to what we saw in 2024.
Okay. One more segment. Workers' compensation. What's the story there?
It's quite different. Pricing is actually still negative, down about 3% in Q1.
Negative pricing. How does that work for profitability?
Well, their assumptions for the year are basically flat claim frequency. So not more injuries, but mid-single-digit increases in medical severity, meaning the cost per claim is going up.
So costs are rising, but prices are falling.
Essentially, yeah.
Yeah.
They expect their accident year loss ratio to be around 100% as a result. The rising severity is basically offsetting the negative rates and flat frequency. It's a tough balancing act.
Interesting how different that line is. Okay, let's switch over to investments in capital. You mentioned the strong income.
Right. $96 million after tax, up 12%. That alone added almost 13 points to their ROE. Big contributor.
Where did they put new money to work?
They had strong cash flow from operations, plus they issued $400 million in senior notes. Altogether, they invested over $900 million in new assets.
At what kind of yield?
Pretty attractive, actually. Average pre-tax yield on those new investments was 6%.
Nice. And that's pulling up their overall portfolio yield?
Yep, the average pre-tax book yield on their whole portfolio increased to 5%.
Any potential downsides on the investment front?
They did flag one potential risk. Volatility in their alternative investments could hit the net investment income numbers, particularly when Q2 results come out, because there's a 1-quarter lag in reporting those.
Okay. So maybe a bumpier ride there in the short term.
Possibly. But they reiterated their long-term expectation for alternatives is still solid, aiming for at least a 10% return over time.
Got it. And their overall capital position, still strong.
Seems so. Book value per share up 5%, helped by profits and also by lower unrealized losses on their bond portfolio as interest rates may be stabilized a bit.
Did that debt issuance impact their leverage?
Yeah, the debt-to-capital ratio ticked up to 21.7% because of those new senior notes. But they said the plan is to use those proceeds for general corporate stuff, including funding profitable growth.
And are they returning capital to shareholders? Dividends, buybacks?
Both. Regular quarterly dividends continue. And they were buying back shares, too. Repurchased about $19.4 million worth in Q1 at an average price around $83. And they've still got about $56 million left on their current buyback authorization. So room for more there.
Okay, let's look at strategy and outlook. Yeah. What are the key initiatives they talked about?
Well, the overriding theme is navigating this tricky environment, markets, trade, recession risks through really disciplined pricing and careful portfolio management.
Makes sense. Anything else on the initiative front? Technology.
Definitely. They highlighted ongoing investments in tech, using AI in underwriting and claims, modernizing core systems for E&S, commercial lines, claims, the usual suspect.
And the goal there is efficiency, scalable growth.
Exactly. They gave an example in E&S where system upgrades let them handle significantly more premium volume without needing a big jump in headcount. That's the kind of efficiency they're after.
Are they still expanding geographically?
Yep, continuing that push. Added 30 new agency locations in Q1. And they mentioned they've expanded into 13 new states since 2017.
Is that expansion paying off?
Seems like it. Those newer states brought in $350 million in standard commercial premiums last year, and they said the profitability is meeting their expectations. So, controlled, profitable expansion.
And the outlook on rates overall, still going up, but maybe slowing down.
That's the message. They expect rate changes to stay ahead of loss trends, but probably moderate a bit from the 2024 pace. And again, they kept their full-year guidance the same for combined ratio and investment income, expecting about a 21.5% tax rate, too.
Okay, so bringing this all together for you, the investor listening, what are the key things to take away?
Well, I think number one is that intense focus on getting rate increases above loss trends, especially in tougher lines like general liability and personal auto. It really shows they're tackling profitability head-on, particularly against things like social inflation.
Right. And the willingness to actually shrink the personal lines book in certain areas to achieve that pricing discipline is pretty telling, too.
Absolutely. It's profitability over just growing the top line. That's a clear message.
And the investment income provides a nice cushion, though we need to watch those alternative investments.
And the expansion efforts, both geographically and through new agency partners, offer clear paths for future growth, especially in standard commercial lines.
What about the competitive landscape? Do they touch on that?
Yeah, their comments suggest they're sticking to their pricing guns, even if it means maybe not winning as much new business right now. They seem to feel some market pricing isn't adequate.
A belief that discipline will pay off long term.
That seems to be the bet. And finally, don't forget the unique situation in workers' comp, flattening frequency, rising severity, negative rates. It's a very different dynamic than their other lines.
Okay, great summary. Now it's time for our This Is Not Financial Advice segment. Throw out an outrageous but plausible trade idea based on all this.
All right, here's one. Given Selective's really aggressive pricing in personal auto, especially in the Northeast, and the general feeling that maybe rate increases industry-wide might slow down next year, consider maybe a short position on a competitor. Specifically, one heavily concentrated in Northeast personal auto that hasn't shown the same pricing rigor.
The idea being Selective outprofits them in the long run.
Exactly. If loss trends stay high and rate hikes slow down, the less disciplined players could get squeezed, while Selective's earlier actions might protect their margins better. Plausible, but definitely outrageous.
Okay, outrageous idea number one. Got another.
How about this? Focus on their strong E&S performance, the growth, the profitability, the tech efficiencies they mentioned.
Right, that was a bright spot.
So maybe go long Selective, but to potentially hedge some risk, maybe simultaneously short a publicly traded reinsurer.
A pairs trade, essentially. What's the thinking?
The thinking is Selective is successfully underwriting complex E&S risks profitably, maybe partly thanks to tech. Reinsurers ultimately backstop a lot of that market. If there's unexpected pain in specialty lines down the road, the reinsurer might feel it more, while Selective's disciplined underwriting could outperform. Again, just an idea to mull over.
Got it. Outrageous, but plausible indeed. Okay, let's wrap this up.
So summing up Selective's Q1, really marked by that disciplined pricing, especially hitting personal lines hard, alongside solid results in commercial and E&S.
Yeah, definitely a focus on getting the underwriting right. Macro headwinds and that potential investment volatility are things to watch for sure.
But the focus on profit, the strategic growth plays, it paints a pretty compelling picture, you have to say.
So for you listening, what really jumps out, how do you see that aggressive personal lines pricing playing out for their market share down the line?
And what about those different dynamics in workers' comp versus other lines? We're thinking about how that mix affects the overall company profile. Lots to chew on.
Absolutely. That concludes our deep dive into Selective Insurance Group's Q1 call. Thanks for tuning in to Talk Tickers.